All right, so I'm recording. Mrs. Olive, market mastery program. Okay, we are almost 50 of us on the call. Let's just, I just want you to stay with me. That's it. Just stay with me. If you stay with me, you're going to understand what I'm going to teach you. All right. If you stay with me, you're going to understand what I'm going to teach you. Because it doesn't take so much. It's very easy to understand. Markets are just like humans. Follow the same pattern, the same behavior every single time. All right. Oh, thank you, Father. Lord, we pray that you open our hearts, let us understand. Help us to understand in the name of Jesus. Amen. So Ashorono says, Coach, what about USD? The news by 1:30 p.m. No, I'm not trading GBP USD till next week. GBP USD has taken my money a lot. So I don't want to trade GBP USD till next week. All right, so that's it. That's why I'm not doing any analysis on GBP USD. Just taking my money till next week. I'm not doing GU again till next week. So market mastery program. We have done module 1, I remember. We have done module 2, I remember. We've done module 3, I remember. Module 4, have we done? Where did we stop? Please, those of you that have been consistent in my class, please tell me, are we in module 4 or module 5? Or module 3? I don't know. I can't remember. I don't know. Where are we? Thank God you have the module here, so everybody can look at it together. Where did we stop? Tell me real quick. Tell me, where did we stop? If in 10 seconds nobody gives a response, I'm just going to continue from module 4, assuming that we have done the rest. All right, so tell me, where did we stop? Module 4. Okay, so that's where we're going to continue from. AC, is it that we have done it or we are about to do it? AC, please tell me. Have we done it or we are about to do it? We have done it. Okay. So we are doing module 5 today. Okay. So market trend, price action, support and resistance, supply and demand. Okay. I think I like today's topic. So let's go straight to module 5. Let's go straight to module 5. Hope you guys, have we done all these bullish patterns? We have not now. We have not done this. Yeah, so this is today's class. Market Mastery Program Module 5, Technical Analysis is what we are doing today. Okay, so here we are. On technical analysis, the first thing we're going to consider is market trend, all right? Market trend. So that's the first thing we're going to consider, market trend. And a trend is a perceived tendency of financial markets to move in a particular direction over time, all right? So when the market is going towards a direction, that's a trend. So that's what you can define as a trend. And these trends are classified as secular for long time frames and primary for medium time frames and secondary for short time frames. So for long time frames, I mean monthly, I mean weekly. So there was a time GBP was an uptrend on a weekly time frame. So whatever you're doing, you're scalping the sale, but you are going hard or you are having an impulsive buy. All right, but currently we are entering a downtrend on GBP USD on a weekly time frame. That's why I don't want to trade it till I see a clear decision for the downtrend, and then we'll join them all the way down. Remember, you don't want to be a decision maker in the market because you don't have the money to. You just want to continue what the decision makers are doing. All right, and here we are. We see that traders attempt to identify market trends using technical analysis, which is a framework that characterizes market trends as predictable price tendencies within the markets when price reaches support levels and resistance levels. So, for example, if you're in a downtrend, every time price comes into a resistance level or a previous support level after breaking it, then you want to look out for shorting opportunities to short the market, opportunities to sell every single time in the market. All right. Now, I want to say this openly. Whenever I'm teaching, if you know you will not stay to the end of the class, don't join the class. And I'm not going to be offended. Don't join the class if you won't stay till the end of the class. All right. I need to address that real quick because the way I teach, I try to connect to my spirit, and my spirit gives the best at the last. I've observed many times. It's always the ending of the class that you now see the best things coming. So don't miss out. It's better you don't join the class at all. Okay. So let's continue. A trend can only be determined in hindsight, since at any time prices in the future are not known. So we don't know where price will get to. So we don't know our potential take profits. Imagine, let's assume, but me, I know, but let's just say we don't know our take profits, but we can use based on insights, we can know our entry, and since price will tend for a direction, we don't know where it stop trending. Like EG now, I knew that it would stop trending at that zone. That's why I gave you that zone as your TP, which is 500 and how many pips? Oh my God, yesterday was so sweet. 53 pips or 54 pips he made, right? So that's the take profits for that downtrend. Now we're going to enter an uptrend for a while, and I gave you the take profits for that one already. All right. So types of trend, we have an uptrend. An uptrend is formed when price of a trade is increasing or rising in value. When the market begins, several traders take advantage of an uptrend to enter a long position to reach high price levels. Like Euro JPY today, we are trying to buy because it's an uptrend. It has broken previous resistance. So we are trusting the buy is going to happen heavily. All right. So just so we don't forget, please, you can set a pending order on Euro JPY. Please, you can set a pending order on Euro JPY. I beg you. Let's all set a pending order on Euro JPY. All right. Let me give you the pending order. Let me give you the pending order so that we don't forget. Let's set the pending order on Euro JPY, everybody. So Euro JPY pending order, entry. Let me type the entry real quick. Entry 140-100. 140-100. I'm going to type it out. Entry 140-100. Stop loss 139,750. That's 35 pips. Stop loss 139,750. Take profits 143,000. I just set pending order. So let me type it out for you. Pending order. Buy limit. Entry 140-100. Stop loss 139,750. That's 35 pips. TP1. TP1 is this level. This is our first take profit level. First take profit is here. So that's 150 pips. That's 141,600. 141,600 is TP1. 150 pips. TP2. TP2 is TP2 is 200 pips. That's 142,100. No, this is TP2 above this level rate. 210 pips. That's 142,200. 142. I'm typing it out, don't worry. 210 pips. TP3. TP3 is 290 pips. 143. 290 pips. Okay. Buy limit on Euro JPY. So I've sent it to the group. Everybody set your pending orders and let's continue teaching. I don't want you to be distracted. Hence why I said we should set our pending orders. So once you have done that, go to the chat box and write pending order sets. Pending order sets. Pending order sets. Once you do that, write pending order sets. Pending order sets or buy limit sets. Anyhow you want to write it. Please, we need to continue the class, so finish that quickly. No, don't write it on this chat. Go to the comment section of the group. Write it on the group. Okay. Okay, so let's continue. Types of trend, we have an uptrend. An uptrend is formed, like I explained already, when we have a downtrend. A downtrend is formed when price of a trade is decreasing in value. So it's just the direct opposite of an uptrend, all right? Again, if you're in a good place, please open your cameras. Let's see each other's face. Okay, so consolidation or sideways trend. The sideways trend happens when, or is formed when markets remain static. It's neither reaching the highest or the lowest price points. It's ranging, all right? So it's ranging. So usually consolidation is when orders are distributed. So it's called distribution of orders because there are a lot of pending orders around that zone that price needs to distribute. We're over 50 on the call already, amazing. To price action, which is support and resistance. Support is the price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. So I think you might need to write that down because it's going to help you out. So you might need to write that down. You might need to write that down. So support is the price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. So let me explain to you the story behind this course. I was in a massive debt in 2021. I was owing over $130,000 because I helped an investor to trade his money and I lost his money. So I was at the verge of committing suicide. This is just 2 years ago, 2021. I was September to be precise. So it was so hard for me because I just started learning Forex immediately and I got a big investor that gave me big money. And I didn't know what to do. So I collected the money and I blew everything. And I needed to pay back this guy. And it was on my head. He brought police to my house. Thank God someone helped me stop him. So the police did not come to my house and stuff. It was a lot. It was a whole lot it was a whole lot to deal with at the time. And this story, I've not said it publicly. This is the first time I'm saying it publicly. I'm honest with you. This is the first time I'm saying this publicly because I want you to understand the story behind this course. If you understand the story behind this course, trust me, it's going to give you much clarity as to why I'm emphasizing that we learn these things because God gave me a promise. He said, I promise you that every single person that goes through this course or this program is going to come out as a successful trader. So that's why I'm confident that this course is going to help you become successful. I'm not hoping that it does. I'm confident that it will because of the promise God gave to me when I was writing this course. So eventually I was able to come out of debt. But I had to write this course first. So I documented my journey, my growth journey. So in 2021, I was in debt. When I came out of debt finally was around April last year. So in May, I wrote the course. I did this course in May last year. And I documented every single thing I learned in Forex that helped me come out of that debt. So I don't know where you are right now. Maybe you're in a debt or you're even in, you don't have money. I don't know where you are right now, but you're going to come out of it. All right. You're really going to come out of it. Why are you going to come out of it? Because the person that wrote this course came out of this. That's why. I live a debt-free life. I'm not owing one person 10 naira. I'm not owing anybody, any single person. I'm not owing anybody. Why? Because I have come out of debt freely. All right. So I'm saying this with so much gratitude in my heart, and I'm giving you hope that you're going to come out of whatever situation you're in right now. Stay close to your charts. Just keep grinding. Just keep grinding. I don't know where you are right now, but it will take you time. eventually you will come out of that struggle. That's a promise I can give to you. Can you share the written course as PDF file for us? And now the reason I might not be able to share it is because there are some modules that I did not explain. Instead, in the modules, I gave a video. Some I did live class for that. You know, there's some modules that I did a live class instead of a slide like this. But let's see. I will see if I can refine it. If I can refine it, then I'll be able to share with you. Okay, so as price of an asset or securities drop, demand for the sales increases, thus forming the support line. Meanwhile, resistance zones arises due to selling interest when price have reached, when price have increased. So imagine price of something keeps going up. Everybody's tired of it, so nobody wants to buy again. They start selling off because the price has gone up. They think they've made profits. Hence why that's a resistance zone. Why suppose when price is falling too much, something valuable. Let me tell you how you know if you're truly valuable. If people still reach out to you at your lowest points, you're valuable. Not reach out to you to help you. Sorry. Sorry. Okay. Someone was trying to call me. I wonder why you're calling me when we're in a class. And the person is my student. You're supposed to be on the class. You're calling me. So someone said the whole course is on David YouTube. Yes, I did the course on my YouTube. So let's continue. Let's continue. So I said, if you're truly, the way to know if you're truly valuable is when you know that you are in your lowest point. Yes, people are still reaching out to you, willing to pay you or willing to partake of your service. That's how you know you're truly valuable. That's the true definition of value. It's not at your highest point you know how valuable you are. It's at your lowest point. Hence why support lines are very important. So when price is dropping, we are still looking forward to buying Euro JPY because it's valuable at that line. It is valuable at that line. If it's not valuable at that line, we're not going to make a purchase of it. So we have volume and concentration. Rather, volume and momentum. Volume is a measure of quantity. In trading, the volume is the amount of a particular asset traded over a period of time. It is the number of units, shares, or contracts that change hands between a buyer and a seller. That's volume. So some people call it volatility. How the volume and the momentum, like it's a measure of the quantity. Now, momentum now refers to the rate of change in prices as opposed to the actual price changes themselves. What do I mean? How fast is so? Volume means price went 100 pips. Momentum is price went 100 pips in 1 hour. That's the difference. That's the difference. Price can go 100 pips across 3 days because there is no volatility in the market. So it has volume. It doesn't have momentum. But momentum is price went like yesterday, 500 pips in 2 to 3 hours. That's momentum. That's some good momentum right there. Okay. Now follow me. Okay, before we get to smart money concepts. Now smart money concept pretty much talks about, it helps you take advantage of the momentum in the market. It helps you take advantage of momentum, not volume. Anybody can have volume. You can speak loud, anybody can have volume. But what's the weight of your word? That's momentum. You said you would do it. Okay. To what extent should we hold reference to your word? That's momentum. Have you seen the difference? So we have volume, we have momentum. Smart money concept is the capital smart money is the capital that is being controlled by institutional investors, market mavens, central banks, funds, and other financial professionals. Smart money was originally a gambling term that was referred to the wagers made by gamblers, or wages rather, not wagers, wages made by gamblers with a track record of success. So in Wall Street, for example, Wall Street is a place I would like to visit very soon. I've not been there before, but I want to be there. I want to know. I've heard Wall Street too much, like it's one big thing. I want to go and see what's going on there. But I will go with my pastor, so they will not lure me into gambling. Anyways, smart money is the capital that's controlled by these institutional investors. So we have traders for the banks and the big, so they are looking for, see, there are zones. So now let me tell you something for a fact. Smart money content is very good if you are a beginner trader because it gives you higher reward for a lesser risk. However, understanding order flow, which is simple support and resistance, but on a more advanced level, it's going to give you an edge. So first, I'll teach you smart money concept. Then I'm going to explain order flow in the coming classes. Because I tell you for a fact, smart money concept is the new liquidity. So market makers look out to clear out the liquidity of smart money concept, guys. So they're looking out to clear out all your stop losses before they now start selling the original sale they want to sell. All right, that's what they're looking out to do, but I'm going to teach you how to avoid them. Just stay with me over the next couple of weeks. So a supply zone is a trader's selling price area. This area is present above the current price with high selling interest. Current price with high selling interest. On the other hand, demand zone is a trader's buying price area. This area is present below the current price with high buying interest. So a supply zone is where I'm looking to sell. A demand zone is where I'm looking to buy. In SMC, price moves from supply zones to demand zones. Now, this is something that when I wrote because I was beaten for a long time. My fingers, the market ate my fingers for a long time before I learned this. I said your ability to identify correctly, emphasis on correctly, supply and demand zones is your most valuable asset. Your ability to identify correctly supply and demand zones is your most valuable asset. It's your most valuable asset. Key factors in SMC. We have a break of structure. Break of structure, when price continues to break previous structure, for example, we had a low, we had a high, price now broke, price went up, then broke the low. That's a break of structure. That's broken the lower structure. So when price continues to break previous structure, and at the same time continue the current trend. So it's breaking the structure downward. Yes, rather previous structure means the high. It breaks the high, but it continues going down. So you say a line is drawn from the recent structure, which is the new high that was formed, to the current breakouts. A line drawn from the recent structure to the current breakout denotes the break of structure. So from that new high up to, how will I explain this now so that you understand? Let me just explain this in literal terms. So look at this. Look at this, guys. This was a sell, right? This was an uptrend. So this is a pullback, then a sell, and price came up, rallied there for a while, then broke this structure. You see this guy? This is what we call break of structure. Are you with me? This one here is what we call break of structure. This one you're seeing right here is what we call what? Break of structure. This particular one you're seeing here is what we call break of structure. Then it gave us a low, a high, and all of this. So hold on a second. Let me continue explaining, and I'll refer back to that analysis. Just hold on. Then change of character is very easy to misunderstand both of them. When price changes its trend, a line drawn from the last high or low, so last high for downtrend or low for uptrend to the previous trend all the way to current price action identifies the change of character. So here we have two things. You have break of structure and change of character right here. Okay. Okay, so look at this, guys. Look at this. Look at this. Low, high, low, because if you're considering this whole structure, this one came higher, then this one came lower, and this one came higher. So look at this. We have different lines. Let me go to the lower time frame, 5 minutes, so that you see it clearly. I really hope I'll be able to explain this with clarity, so much clarity for you. I don't want you to be confused. God, please help me. I want to explain this with so much clarity so that you can understand what I'm saying. I want to explain this with so much clarity. God, please help. Okay, so you see this is a low, this is a high. On the lower time frame, you can even call this one here a change of character. So change of character to the upside, it shows that soon we're going to see an uptrend because no, you can't even call this one. This is noise. So let's say this one here. After this high, it came down, right? Then this guy came and went above it. This is change of character. So after a change of character, you're looking to enter and ride for the break of structure. All right. So that's a risky trade. Or if you're not choosing to, so change of character occurs before before break of structure, right? I think yes. I don't want to explain with confusion. Me, I understand it, but I don't know how to explain this particular thing. I'm sorry, guys. Please just hold on. Just hold on. Okay, good morning. Just joining. You're welcome, Edo Praise, but you are late. So we have classes on Wednesdays, 2 p.m., Thursdays, 8 a.m., and then Mondays on YouTube live class. So that's not for everybody, just for those that feel like joining me on YouTube every Monday. I have a live class by 8 a.m. So the change of character occurs first, which is here. Right here, we see the change of character. Yeah. Then this is the break of structure. Yes. This is the break of structure. Yes. So this is the change of character. This is the break of structure. So after the change of character, I might look to write the price because I've seen a change of character. Change of character means, okay, soon you're going to see an opposite move. Then break of structure means, okay, now we have confirmed the buy. So most times I like people entering after the break of structure. So wait for the break of structure, because after change of character, it might be a fake out. But me, I know I'm ready to risk it. So if I'm entering around this zone here, obviously my stop loss will be here. So that's just a little stop loss, and I'm willing to lose it. All right. But after the break of structure, you're most likely not going to be wrong. It's hard for you to be wrong. I'm serious. It's really hard for you to be wrong. That's why I bought here now. I told you guys that I entered the buy here. I took out profit here. It's hard for you to be wrong if you are entering based off of change of character. It's hard for you to be wrong. I'm serious. It's very hard for you to be wrong. If you're entering based off break of structure, sorry, not change of character, break of structure. So while liquidity is the buildup of stop orders residing on a trend line of equal highs, lows, trends, or wicks, this is money that can be taken out. So buildup of stop orders, for example, if people have their stop losses around a zone, when you see a high, they'll tell you that you keep your stop loss above the high if you want to sell, right? If you not see another high again, two highs along a zone, that tells you a lot of people's stop loss are above there. So what price wants to do is to take out their stop loss, then continue going down. That's why that taking out that stop loss, someone will call it change of character, because it is a change of character. But it's not a break of structure because it did not close above. If it closes above, then they're going to continue going up. But if it just goes with a week and comes back down, a week mainly on the hourly time frame, mainly hourly or 4 hours, a week and it goes back down, then it's not a break of structure. So it's just to clear liquidity, change of character, pretty much. Then imbalance, okay. I've explained this many times. Imbalance is the gap of in a candlestick that is created when price moves quickly. When price moves quickly, there's a gap of a candlestick, and it represents the orders that were left unfulfilled. It's also called inefficiency or fair value gap. What do I mean? And you spot that on a higher time frame. So here, price moves quickly, gave us an imbalance. This was the imbalance here because there was a gap. So price needs to come and fill this imbalance. So guys, look at this. In case this guy does not come down, another thing I want to do is to wait for it to break this higher structure then I'll ride it up. If it doesn't break the higher structure, I'm not going to ride it up. That's why I said don't sell, only wait for buys. Don't think you're trying to sell and be smart. You hit your stop loss. If it breaks above this place, then I can now look for a buy. But a short sell, because this is a supply level. Anyways, just be careful with your trade. That's it. Be careful with your trade. Anyways, this was the imbalance that was formed here because price moved quickly, and now you draw imbalance from the previous structure up onto the new structure, the previous broken structure. So this was the previous broken structure here. So the imbalance starts from that structure, the gap from that structure up onto the new structure, which is here. So price cannot continue going because there are unfulfilled orders here. And usually, the best entry points are for a buy. The best entries are entries below imbalance. Entries below imbalance are the best entries for a buy, which is this level here. Below imbalance is the best level for a buy. Is the best level for a buy because it's below imbalance. Are you with me? These are the best entries for a buy because it is below imbalance. So now let me teach you something. If London session takes out Asian highs first, they're coming next to take out Asian lows. If they take out Asian lows first, they're coming next to take out Asian highs. Don't forget. This is something that you must not forget. Okay, no, you can delete that one. It's not a valid one. If they take out Asian lows first, they're coming next to take out Asian highs. They take out Asian highs first, they're coming next to take out Asian lows. So there's already a trend line liquidity here. So they're still coming down. Don't worry. So if price comes here, maybe to this psychological level 142, I might take a short sell up until they clear out this thing, which is about 150 pips sell, just for them to clear it out, because they're going to clear it out. I bet you that they're going to clear out. This is liquidity I'm seeing already. Anyways, we're talking about imbalance, and I said it's the gap from the previous structure after a mega push from the previous structure up until the new structure. Same with this level here. See imbalance from here. This is the imbalance because there was a gap from here to this place. That's the imbalance. There's a gap. So price needs to come and fill it up. That's why price pumped up into this level before selling. So where is the supply level? Why the price sell from here? See this candle. This indecision candle. This was the supply candle that made price to push itself down after clearing the imbalance. Are you with me? After clearing the imbalance, price started moving down. I don't want you to try to know so many things because the more you know, the less profitable you are in the market. And it's the truth. All right. The more you know, the less profitable you are because you're trying to think of why you should not do it and why you should do it. I don't think too much. I just click my buy. Whatever happens, no problem. I'm not looking to be right all the time. I'm looking to be right more than I'm looking to be wrong. That's just it. So let's go on to the next, which is supply zone. An area in the market where price failed to move further up, thus fell from, like that zone I just marked out. Price failed to move further up, thus it fell down. That's a supply zone. Bullish order block, same as supply zone. Highlighting the last bullish candle before the massive drop in price. So the bullish order block is for a sell, bearish order block is for a buy. Bullish order block was the last bullish candle before the massive drop in price. The last bullish candle. And bullish candle does not mean the color is white or the color is green. No, a red candle can be a bullish candle, like what I highlighted. If it meets the parameters for a bullish candle, what are the parameters? Price was trying to, so the buyers won the fight. So price, a candle is formed, and I imagine it to be like a fight. When I say a fight, I mean the buyers and sellers, they're in a battle, so they're trying to win. Who wins? All right. And now the bullish order block tells us that rather the bullish candle tells us that buyers won, even if it went down, but it started going up and it didn't even change color. It's still a red candle. All right. But if I see the rejection, the weak rejection is very long, then that's a bullish candle. So it doesn't matter the color. That's why some people use the same color for all their candles. I have a friend, Fziba. He uses the same color for all his candles. He doesn't have a white or red. No, 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 no. It's black candles he uses. But yes, he can identify order block. He can identify bullish candles because it doesn't matter the color. What matters is if the parameters are met. Parameters for a bullish move, if they are met. There's some candles that will even have long body of red, but the wick was very healthy rejection. That's a bullish candle. We are ready to fly with that one. We are not looking for so much. Now, demand zone, an area in the market where price failed to move further down towards it rose from. All right. So some people also call it support levels. Why supply zones? Some people call it demand resistance levels. All right. So I like marking out these zones from the H4 time frame, and I'm going to show you how you do that right now. So bearish order block, I've explained. Same explanation I gave for bullish order block is same you use for bearish order block. Price was trying to go up, but it closed with a very long wick above. That's bearish. That's bearish. Bearish. Okay. All right. If you even check it, this is June 21. Can you see the screenshots? June 21. I told you I started making this course in May last year. This is June 21, Tuesday. I took a screenshot from my iPad. June 21. I can remember very well. I still had swipe coin. No. I am. Oh my God. So we have a candlestick chart. Candlestick chart. I took this screenshot from my iPad. A candlestick chart represents a history of price movement. A history of price movement. It is also named because the price is recorded in vertical bars called candles. Each candle with its body or wick represents the open, close, high, and low of price movement for a specific period of time. Don't miss out of the specific period of time because that time is important. You see maybe you are looking at the right candle, but you're looking at the wrong candle because you're looking at a 4-hour candle. Meanwhile, I'm looking at a 5-minute candle. So don't mistake that time. Don't ignore it. It's very important. A candlestick chart can be viewed on different time frames from 1 minute to 1 month per candles. And guess what? We even have if you're using the premium, you can use 2 years candle, 3 years candle. Yeah, you're using trading view premium and stuff. A candlestick has no body. All right, so this is candlestick anatomy. A candlestick has no body or colored position and a wick. A candlestick has a body, the colored position, and a wick, which is the line, which represents the open, close, high, and low of price movements for a measured amount of time. A bull candle is a candle. Okay, now pay attention to this. A bull candle is a candle where price, excuse me, a bull candle is a candle where price closes above the open. A bear candle is a candle where price closes below the open. All these things you already know, but it's good for a refresher course. All right. However, there are several candles that show future price movements, e.g., hanging man, shooting star, inverse hammer, morning star, evening star, etc. We'll go in depth later in this module, so relax, don't rush. Now look at this. So this is high, low, close, and open. That's a bullish candle. Then this is a bearish candle right here. I just illustrated this for you to see. You can take a screenshot of this. Yeah, you can take a screenshot of this if you don't mind. Because I am not sure, I will try to review this module so I can send it out as PDF. But in case I don't send it, just have a screenshot, have it recorded somewhere. All right. Then candlestick chart timeframes. Okay, so each candlestick chart timeframe provides different levels of price movement data, similar in concepts to zooming in or zooming out of the market. So your 5-minute chart, if you zoom out, like you come out, zoom it. How did it zoom it out now? Yeah, you see more candles, right? The more candles you see, if you go to 15 minutes candle, it's the same movement. It's just on a less specified range because 5 minutes is more specified and it's more noisy, right? So and each candlestick actually they determine the relative length of a trade or trading style that a person wants to trade. Here's a list of several trading styles and commonly used chart timeframes associated with them. So for scalpers, they are in the trade for minutes to hours. So they use the 1 minute time frame, 15 minutes time frame, and 5 minutes time frame. But this is my advice for everybody. Whether you're a scalper or you're an intraday trader or you're a swing trader, please never ignore the H4 time frame. I beg you, don't ignore the H4 time frame. Don't ignore it. Don't ignore the H4 time frame. On no account should you ignore the H4 time frame. You're going to be trading on a very hot furnace if you are ignoring the H4 time frame. We have intraday trading. Intraday trading, which is from hours to days. Like I'm an intraday trader. I also scalp sometimes, but I'm more of an intraday trader. So I go to 15 minutes time frame. That's the lowest I come to. If you notice when I'm teaching you guys, I go straight to 15 minutes time frame to look for entries. But H4 and H1 is where I spot out my market structure. And swing trading, you hold your trade from days to weeks. Like God, I can't remember. Okay, I think it was CEO ever something. I heard that Euro JPY sell. Yeah, that's a swing trader from days to weeks. He held it for over a week. All right. Position traders, they hold their trades for months to years. Now, Warren Buffett trades the forex market, or he's a position trader. He trades this forex market with us, but he's a position trader. So he can hold his trade for like 4 years. Yeah, his money is there. And he's not going to the market every time to look at, what is the market doing? What's the market doing? He's not looking to make 1 billion. He's looking to just make an extra, maybe 500% on whatever amount he keeps. And that one is going to be like a plan to feed him in another 5 years or 10 years. I don't know, but he's a position trader. That's just what you should know. I don't know so much about that. So my candlesticks pattern, a candlestick tells a story of price journey from start to finish. It shows us the extent to which price sojourned in bracket highs and lows. There are 3 main types of candlestick patterns. There are bullish candlestick patterns, bearish candlestick patterns, and continuation candlestick patterns. Each will be discussed as we proceed, so get ready. And now I want you all to get ready to take screenshots. That's why I said you should not leave this call. This is the important part that is for only those that have stayed to this time. So get ready to take screenshots, guys. We have bullish candlestick patterns. They may form, bullish patterns may form after a market downtrend and signal a reversal of price movements. They are an indicator for traders to consider opening a long position to profit from any upward trajectory. Example, we have AMA. The AMA candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downtrend. A AMA shows that although there were selling pressures during the day, ultimately a strong buying pressure drove price back up. The color of the body can vary. Are you with me? The color of the body can vary. It doesn't have to be green or red. The color of the body can vary, but green AMAs indicate a stronger bullish market than red AMAs. If it's green, it's stronger, but even if it's red, it's still telling you a reversal is close by. All right. So this is a picture of it right here. This is a picture of it. This is what a bullish hammer is. Inverse hammer. Inverse hammer. Inverse hammer. It must be with 2 other candles. All right. So a similarly bullish pattern is the inverted hammer. The only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the price down. The inverse hammer suggests that buyers will soon have control of the market. Now, if you see only this hammer here, it's not inverse hammer. Let me show you an instance. 15 minutes time frame on GBP USD yesterday. Right here. See, this was why this trade hit our stop loss, because this is inverse hammer here. So all I was waiting for was another bullish candle to come up into this level, retest, then come down. Then I'll trust the buys. But it didn't do that. I'm like, okay, let's still take the risk. I was just trying to take a risk, because from what I saw, it was not going to buy. Assuming this thing followed by a heavy bullish candle, this alone is a bearish move. But if it is followed by a bullish candle afterwards, it's a bullish move. Are you with me? It's a bearish move on its own, but if it is followed by a bullish candle afterwards, the bullish move. Let me look for a perfect example. Look at this perfect example here. This is what we just analyzed right now. So this is a downward move. This is that hammer. This is a bullish move. Hence why we are seeing these heavy buys. You understand? This is a perfect example of it right here. So whenever you see this in the market, just buy. And you must see it on a very relevant price point, not just on any zone. You see it, you now want to buy. I will laugh at you. Price will just ridicule you. Same you see here. See, after a bullish move, actually sold here. After a bullish move, you see this candlestick reversal pattern. Just take a move. These are reversal patterns that price form every single time. See it here again. This is the opposite of it. See it here. A bullish move, that candle, then a bearish move. Hence why we saw this sell. See, you need to pick 1, 2, or 3 candlestick patterns that you want to be working with and try to understand them very well. See this candlestick, see this reversal pattern also here. What I just explained right now. See, can you see it here? Can you see it here? Can you see it here? After this, I'll just look out to sell. This is a very clean reversal pattern. Very clean. After this, we look out to sell because we have seen these 3 candles together. So we look out to sell. Thank God I'm showing you an actual chart so that it doesn't look like this is textbook chart. No. This is real chart, bro. This is real chart. Okay. Then this is the hammer we spoke about. This is the hammer we spoke about. See that same candlestick pattern again. It's common on GBP USD. See that same candlestick pattern here again. All right. Then this is the hammer we spoke about for a sell. See that sell hammer here. See that sell hammer here. It happens every time in the market. All right. It happens every time in the market. Then there's another pattern that you are going to see. I will show you that one. That is bullish engulfing, which you can see here. After a bearish candle, you see a bullish candle that engulfed it. Just know that we are going to buy. Just know that we are going to buy. All right. So that's pretty much it. See, price did not break that level I marked out. Though. Price did not break it. So we'll just wait for price to come down here. Wait for price to come down and we'll buy price. We're going to break this trend line. I told you it's liquidity. It's going to break it. Of course. Wait for price to come down and you make a move with price. I can't see anybody's face again, but this is not what we agreed now. People are covering your face. This is not what we agreed. Everybody has covered their face. All right, thank you, Franz. I'm seeing your face. So this is the inverse hammer. Bullish engulfing now. The bullish engulfing pattern is formed of 2 candles, and I've shown you that in the market already. The first candle is a short red body that's completely engulfed by a larger green candle. Although the second day opens lower than the previous, lower than the first. The bully or the not second day, because this I'm looking at it on the daily time frame. It might be a candle. So let's say although the second candle opens lower than the first, the bullish market pushes price up, culminating an obvious win for the buyers. All right. So piercing line. This one is I've not really mastered this one. I'll be honest with you guys. But don't forget to take a screenshot. The piercing line is also a 2-stick pattern made up of a long red candle followed by a very long green candle. There's usually a significant gap down between the first candlestick closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed to or above the mid price of the previous day. So you see this mainly on the daily time frame actually. So during weekends, there's a gap that price usually form. That's what you look out for piercing line for. But for now, don't really dwell much on this. I've been profitable without it. Morningstar is considered a sign of hope in a bleak market downtrend. It's the 3-stick pattern, one short bodied candle between a long red and a long green candle. All right. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signifies that the selling pressure of the first day is subsidizing of the first candle and a bull market is on the horizon. So what it means is this wick that is in the middle candle here, the wick must not come all the way up. It must not. If it comes all the way up and is longer than this next candle afterwards, that's not morning star. This next candle must cover completely that previous middle small candle. All right. 3 white soldiers. Okay, this is very common in the market. Let me show you. 3 white soldiers. They occur after 3 candles. It consists of consecutive long green or white candles with small wicks, which open and close progressively higher than the previous day. It's a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. Trade entry strategy for this pattern differs from others. So let me show you white shoulder, 3 white shoulders. Let's go to a bullish market. See 3 white shoulders here, guys. 3 white shoulders. 1, 2, 3. Thank you. After 3 white shoulders, after a retracement, go aggressive on your buy. That's why I bought here. Honestly speaking, the only reason I bought here was because I saw 3 white shoulders. I bought here because I saw it first gave me engulfing, bullish engulfing. Then 1. So remember here we see many reversal patterns. Very plenty. Look at this. See, first reversal pattern we see here is the hammer we spoke about. Second is indecision candle. This red candle here, equal wicks above and below. Third is bullish engulfing. Fourth is 3 white shoulders. 1, 2, 3. When it retested, why did you not buy? What were you see my line? I bought. What were you looking for? Why did you not buy? I bought too. Me? I bought because I've seen reversal pattern already. And when it came here, I took a buy. Yeah, I did it. I took a buy. These candlestick patterns, if you understand them, it's going to give you an edge when you're trading. This is 3 white shoulders I just explained here. All right. Let's look for it somewhere else in the chart. So 3 white shoulders must not have any wick below it. See, no wick below the candles, no single wick below the candles. If he has wick below the candle, it's not 3 white soldier, please. It doesn't have any wick below the candles. That's why it's 3 white soldiers. Okay, I don't think we have seen anyone again. But if I see anyone again, I'll show you guys. All right. If I see anyone again, I'll show you guys. I don't think we have seen anyone. For now, this is the only 3 white soldiers I see. It doesn't happen every time, but whenever it happens in the market, please don't think twice. Wait for a retest of that 3 white soldier, beginning of it. Enter at the beginning of that 3 white soldier. And ride price all the way. All right. Oh, it's been a long day already, and I'm taking you guys' time already. Price is coming down as predicted. Amazing. It's going to break this trend line, so don't be afraid. Don't bother. It's going to break it. Come here for us to enter. So just relax. Don't rush, baby. So let's look at what we're considering. Okay. So here we are. I've explained 3 white soldiers. Bearish candlestick patterns. I told you it's just the opposite of the bullish candlestick patterns. We have the bearish hanging man. Hanging man. It looks like a bullish hammer, but it is in a resistance zone. So it is a hanging man. It looks like a bullish hammer, but it is in a resistance zone. So it is a hanging man. All right. So it indicates that there was a significant sell-off during the day. Buyers were not able to push price up again. And usually it is followed by a heavy bearish candle. All right. Shooting star. This one, you already know that it denotes that, there's rejection there. Imagine you jump up and hit your head somewhere, you fall immediately. That's what happened there. Hence why we'll see movement downwards. Bearish engulfing, I told you already. The next candle covered completely the previous buy. Evening star, same thing. Same way with the morning star, but this is evening star because it is opposite. So we have a buy, we have an indecision candle, then we have a mighty sell. Three black crows is the same with three white soldiers, but it is going opposite, downward. Dark cloud cover. This is for daily time frames, mainly daily time frames. So don't really focus on this, but you can take a screenshot and study it. I mean, I don't even look out for this thing in the market. This particular one, I will be honest with you, I don't look out for it, and I've been cashing out. So don't need to learn everything. As I said, the more you learn, the less profitable you are. Just pick one or two that you learn. So continuation pattern, exactly. Continuation pattern. When market open, okay, so we have a doji candle first as continuation pattern. Sorry. So I said continuation pattern. Oh, wow. See as I'm pulling everything down. Sorry, guys. Sorry, guys. So I said continuation pattern is when you have the market opening price and closing price. Then you have the market opening price and closing price are along the same, at almost the same price points. The candlestick resembles a cross and a plus sign. So it resembles a cross and a plus sign. All right. The trader should look out for a short to non-existent body with wicks of varying length. Doji pattern conveys a struggle between buyers and sellers, blah, 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 blah. So this is it. Whenever I see two indecision candles around the same level, two around the same level, price is going to continue what it started. If it was going up and you see two indecision candles around the same level, price is going to continue going up. All right. And this is continuation pattern. It can also denote reversal if after the continuation pattern was a very strong reversal pattern. Like we saw a doji candle first in that GBP USD analysis I showed you. So a doji candle down that has three white shoulders. So a doji candle, then we saw a bullish engulfing, hence why price did not continue going downwards. All right. Spinning top is same. And whenever you just see two candles showing the same thing, like the same length, the same breadth, the same everything, or almost the same, it's more or less a continuation pattern. So don't look out for reversals yet, unless you now see after that a strong reversal pattern. Then be sure of the reversal. So this spinning top, these three falling methods. So three bullish candles with on a very heavy sell. Let me show you this one. I like this particular three falling method. I've been following three method. Let me show you. Do I have an example of it on EuroJPY? Do I have an example of it? Do I have an example of it? Okay. Okay, I do. Look at. I do. After this heavy buy, we saw these three candles down, down, down. That's following three method to continue the buy. This is a continuation pattern. Someone will see it now and say price wants to reverse. No, sir. It's not reversing. It's a continuation pattern. All right. Let's take this one out. Let's look for another one. So here again, we see it here. After this movement up, we see three falling three methods and a continuing move upward. So this is a continuation pattern, not a reversal pattern. It happens in the market, not really every time. So me, I used to look out for it on daily time frame, actually. Daily time frame. That's when I look out for that falling three patterns. That's what happened on gold. Let me show you. Can I still find that gold analysis? That's what happened on gold some days ago. That's what happened on gold. That's what happened on gold. Where's gold? Thank you. Yeah. This is good. Yeah. I saw it on gold. This was rising 3 methods. So this is a continuation pattern. After a heavy sell, we see 3 move upward and we'll continue our sell. Yeah, I saw it on gold. I know I saw it on gold. I saw it on gold. I know I saw it on gold. All right, so it's a continuation pattern. I look out for it mainly on the daily chart to tell me if you are still in a good sell position, because this is a reversal pattern. This is a reversal zone. So for price to have done these 3 moves, it means we are not going to respect this zone. We are coming to the next zone, which is this zone. That is why I sold here, because I saw this move, which means price is not ready to reverse here yet. It's going to continue going down. I remember. Here also, this is a reversal zone. If I see something like that, yeah, then I'll be looking forward to selling and not buying. All right. This was my analysis, and it was a very clean buy we had. Buy up onto this. Yeah, I remember I saw that. Okay. We don't have so much time again. I'm trying to rush at the same time. I don't want us to miss out on what we need to do. It looks like we're almost done. Yeah, we're almost done with that module. Okay. Rising 3 methods, I showed you that already. Top to bottom analysis. We can't do this today. We cannot do this one today. Module 6. Okay, we can't do top to bottom analysis today because it's going to take a long time. However, I'm going to recommend a video. Come to YouTube. Everybody come to YouTube right now. Go to YouTube, search David Acham. Everybody do what I'm doing right now, please. Come to YouTube and search David Acham. Everybody do that right now, please. Right now, please. Come to YouTube and search David Acham. Click on David Acham here. Click on playlist. Market mastery program. View full playlist. So top to bottom analysis. I did this on June last year. Yeah, you can come and watch it. I did this in June last year. You can come and watch it. However, I'm going to redo this. This top to bottom analysis, I'm going to redo it next week. But just for the sake of this class, and so you can have an edge, come and watch this top to bottom analysis. I'm sending it on this Zoom chat here. All right. I've sent the link on the Zoom chat. So click on the link on the Zoom chat right now before it clears off. Click on the link on the Zoom chat and go and watch it. Top to bottom analysis. Okay. Go and watch it. It's going to give you an edge in your trading. All right. So you go and watch it. I think that's all for today. Let's end the recording. If you have any question, please go ahead and ask. We are still strong. About 50, 40, 45. Okay.